All right, let's just jump right into this because it's a huge claim. I mean, think about it. With everything going on in the world, high prices, all the uncertainty, could we actually be living through the best investment environment ever? It sounds kind of crazy, right? But that is the exact argument we're going to break down today. And look, this isn't some random hot take from the internet. This is a direct quote from Rick Reeder. He's the Chief Investment Officer of Global Fixed Income at BlackRock. We're talking about the guy who helps manage a truly massive amount of the world's money. So when someone like that says something this optimistic, you kind of have to sit up and listen. What is he seeing that maybe the rest of us are missing?
And that's really the big question, isn't it? It just feels so counterintuitive. So let's unpack his thinking, piece by piece, and really try to understand the logic behind this incredibly bullish view of the world.
Okay, so here's where Reeder's argument really gets going. It all starts with something that's actually pretty rare in the markets. It's not just that one thing is doing well. He sees this powerful, simultaneous boom happening in the two biggest asset classes on the entire planet.
Now, what's so interesting here is just how unusual this is. Usually, it's like a seesaw. When stocks are on a tear, bonds are kind of boring, and when people are rushing into bonds, it usually means they're scared of what's happening in the stock market. But Reeder's point is that right now, you don't have to choose. Investors are getting really compelling opportunities on both sides of the ledger. Let's dig into each one.
So on the stock market side, this isn't just about good feelings. There are some powerful forces at work. First off, there are literally trillions of dollars just sitting on the sidelines, in cash, in money market funds, just waiting for a reason to get invested. At the exact same time, companies are buying back their own stock at a crazy pace, which shrinks the supply of shares out there. And maybe most important of all, this whole thing is being supported by actual, real earnings. And that earnings point? It is driven by one just staggering number, 54%. That is the year-over-year earnings growth for the Mag 7, the biggest tech stocks in the market. Reeder's argument is that with growth like that, even the high prices we're seeing today start to make a whole lot of sense.
Okay, so that's the equity side of the boom. Now, let's talk about the other side, income. Reeder points out that right now you can build a solid bond portfolio that yields somewhere between 6.5% to 7%. Now, think about that. With core inflation running below 3%, that's a fantastic real return. You're actually making good money after inflation. So, we've got strong stocks and we've got attractive bonds. That's the two-sided boom. But there's a third pillar to Reeder's argument. It's a little less obvious, kind of a hidden advantage in how the market is working right now that he says creates a really unique safety net for investors.
He points to this thing called volatility, or vol, as the pros call it. And right now, he says it's trading at crazy low levels. But what does that actually mean? And why is that so important to his whole argument?
Well, put simply, you can think of volatility as a measure of the market's mood swings. When volatility is high, the market is jumpy, prices are swinging all over the place. But when it's low, like it is now, it means things are pretty stable and calm. And that stability, it has a very, very powerful side effect.
So here it is, the key takeaway. Because the market isn't swinging around like crazy, the cost of buying insurance against a big drop, what investors call hedging, is incredibly cheap. And this is what Reeder calls an escape hatch. It means you can stay in the market, you can capture that potential upside without having to take on all of the downside risk, because protecting yourself is just so affordable. Okay, so it can't all be sunshine and roses, right? Even in what seems like a perfect setup, Reeder does point to one major risk. And it's probably not what you're thinking. It's not inflation, it's not a recession, it's more of a psychological trap.
Complacency. That's it. That's his single biggest worry. When that escape hatch is so cheap and everything looks so good, the real danger is that investors just get lazy. They underestimate the risks, they stop buying that cheap insurance because they figure, hey, I won't need it, and that leaves them totally exposed if things do eventually take a turn.
So, keeping that one word of caution in mind, where do we actually go from here? Let's take a look at Reeder's view on the future, especially what he thinks the Federal Reserve is going to do next. So Reeder's take on the Fed is pretty interesting. He argues that today's high interest rates, they're not really fighting inflation where it counts because big, healthy companies just aren't borrowing that much anyway. Instead, he says, these high rates are mostly just hurting the housing market and families that rely on credit. And for that reason, he fully expects the Fed to start cutting rates, maybe even as soon as this September.
But hold on. If the Fed cuts rates, won't that just make inflation spike all over again? Well, Reader says no. And the reason is because of another massive trend that's happening in the background. He believes we are in the early days of a once-in-a-generation productivity boom, all driven by these huge leaps in data, computing, and technology. This, he says, will keep the economy running efficiently and keep a lid on prices.
So, let's put this all together. Here's the chain of events he predicts. Step 1. The Fed starts to cut interest rates. Step 2. This happens at the same time as this historic productivity boom, which keeps inflation under control. And step 3, the combination of lower rates and all that cash on the sidelines creates a flood of liquidity that could just keep pushing up risk assets, from stocks to, well, you name it.
Which, of course, brings us to the final question. If this very optimistic scenario actually plays out, if we get falling rates, tons of cash, and low volatility, what does that really mean for the markets? Well, the theory suggests it creates an incredibly supportive environment for taking on risk. And it kind of leaves you wondering, if this really is the best investment environment ever, are you positioned for it?